SCHD is known for consistently beating the market and giving amazing returns. However, to start 2023, it's lagged considerably behind the market, returning negative 7%, while S&P 500 shareholders, they would be up 8% year to date. Has SCHD finally went out of touch? Are they finally out of time? It's possible the SCHD we've come to love has changed forever. In fact, the SCHD that you loved last year, I know for sure it will never be the same. One reason for the decline of SCHD could be because the fund has a 31% portfolio turnover rate. A portfolio turnover rate refers to the frequency in which the fund's holdings are bought and sold within a particular period, usually a year. Now, a fund with a 30% turnover rate, that means about 1/3 of the fund's shares have been replaced at some point in the last year. Now, remember, SCHD isn't actively managed by a fund manager for the day-to-day trades. Instead, it's passively managed by tracking the US Dividend 100 index. This index gets rebalanced every year in March, but not by emotional decision-making, but instead by passing certain criterias and screeners. This includes 10 consecutive years of dividend payments, shares must be liquid, it looks at some financial metrics such as free cash flow, return on equity, as well as the 5-year dividend growth rate of the companies. This is a great safeguard to avoid having companies like Tattooed Chef appear in the portfolio. So for these reasons, this is exactly why, even though we may own SCHD in our portfolio every year, the companies that actually consist of it is constantly evolving. SCHD's most recent March reconstruction added 14 new companies, and although there are 102 holdings in SCHD, not all of them get weighted equally. Being weighted by market cap, no single stock can be more than 4%, and no single sector can be more than 25% during the portfolio construction. Now, one potential big problem with SCHD is that when they do their weighting by market cap, that means the top 10 holdings alone are 42% of the portfolio. In fact, just the top 15 holdings are about 60% of the portfolio. So if those 15 positions do well, chances are the overall performance of the fund will do well. If those positions do poorly, the fund is also going to struggle. Looking at their top holdings and year-to-date performance, it's not hard to understand why SCHD is lagging. Remember, the S&P 500 so far is up 8% year-to-date, but one of SCHD's largest positions is AbbVie, and they're down 9%. That's a swing of 17% in underperformance. Amgen is down 11%, Chevron down 13%, Home Depot down 8%, UPS and Verizon, they're still in the red for this year. In fact, we only have 2 positions in their top 10 that are actually doing better than the market, in Broadcom, which is up 13%, and then we also have Pepsi, which is up 8.5%, just barely beating the market. When we look at SCHD's sector breakdown, we can see the largest sectors by exposure are also underperforming the overall market. Industrials with a total return of just 1%. We have healthcare down 2.3%. Consumer staples up just 3.6%. Financials down 8.4%. The 2 sectors that have really propped up the market this year are technology and consumer discretionary, which are up 23 and 15% respectively. Those 2 sectors only make up about 20% of SCHD's portfolio. So because SCHD doesn't have as much exposure to the big winners of 2023, the fund is of course going to be lagging behind. So now we know because SCHD's largest individual positions aren't doing so hot, because the best performing sectors are not the ones that make up a good amount of SCHD, and because the portfolio is changing every year, is this a reason to give up and sell out of SCHD while we're ahead? Well, if you're somebody who only expects stocks to go up, it might be time to sell. Best of luck finding an investment that only goes up. We can see throughout history, SCHD has had multiple times when it went up or down or traded sideways, but in the long run, it always went up and it reached brand new all-time highs. And ultimately, I know what most of you care about is that juicy dividend that SCHD gives out. It currently trades at a starting yield of 3.8%. And that dividend is still intact. In fact, every March, June, September, and December, SCHD is still paying out that fat dividend. That's the beauty of owning so many wonderful companies, is that even if some companies are struggling, others in the fund are going to be doing well, and they're still going to be sharing that cash flow with investors. Another wonderful thing about SCHD is that it has proven to raise their dividend over time, and that's because of the screener criteria the fund looks at. It looks for companies that raise their dividend, and this is a chance to make more and more money each year for just simply holding on to an ETF. Stocks and sectors, they're always going to be going up and down. It's all part of the normal fluctuations of the stock market. Here we can see the best performing and worst performing sectors of the past 15 years. We can see that sectors alternate between having hot years and ice cold years, but the most important thing is that in the long run, every single sector, I'm talking about every single one of them, has had a positive return in the long run. Buying stocks at a discount and waiting for them to go up is the key to making money in the stock market. Patience is a virtue. Patience is not the ability to wait, but the ability to keep a good attitude while waiting. I loved SCHD when it was beating the market every year. That's exactly why I'm scrambling to buy more shares at a discount. I'm getting a high starting yield of nearly 4%, but more importantly, I'm getting a basket of wonderful companies that get screened every year for high quality, sustainable dividends, diversification, strong financial ratios, tax efficiency. These are all things I'd look at when determining to buy a company. But Charles Schwab, they do all the work for us for a super low expense ratio of just 6 basis points. Now, not that I would ever advocate for it, but if SCHD was 100% of my portfolio, I could still probably sleep pretty well at night. We just came out of a 10-year plus bull run. A lot of you, this is your first time seeing stocks and ETFs not just going up. But if we look at history, the economy will inevitably get better. Now, if you want a place to talk about dividend investing, here's your chance to join other like-minded dividend investors by joining the Dividend Discord for free in the comments below. I'd love to hear what you think about SCHD. Make sure you hit that like button to help a small-time YouTuber, subscribe, catch my videos in podcast form under the Collect Cash podcast name. Thank you to all the Patreons that make this channel possible. If you can't join the Patreon, a great way to support the channel at no extra cost is to just hit the Amazon affiliate links right before you buy something on Amazon, and I will get a small commission at no extra cost to you, and I will buy, stash, and collect cash you later